stripping away the politics and the morality of incarceration leaves us with a single clinical equation. We're looking at one of the most profitable per-square-foot business models in America. This is a comparison between standard franchise economics and a private detention facility. While a fast food chain might run on a 7% profit margin, a well-managed prison commands margins between 35 and 45%. This business model treats the facility as a warehouse. At these margins, the occupant is the inventory required to activate the asset. 96% of the private beds in the United States are controlled by a three-company oligopoly: CoreCivic, the GEO Group, and MTC. This chart illustrates the circular logic blocking new competitors. State laws require demonstrated history, meaning a company must already manage a prison to bid on a contract. These laws create an unbreakable legal moat. Incumbents face zero threat from newcomers, freezing the market in place. Because you cannot build a company from scratch, entry requires buying an existing facility on the secondary market from one of these major operators. A mid-tier 1,200-bed facility requires a massive upfront capital investment, typically ranging from $80 to $150 million. The industry is mathematically designed to exclude new capital, while guaranteeing the current players a captive, uncompetitive environment. The fundamental revenue mechanism is the per-diem contract. The government pays a fixed daily rate for every person. These contracts feature guaranteed minimums. Even if cells sit empty, these clauses ensure steady revenue by preventing the paid occupancy count from dropping below a set threshold. Historically, these companies organize themselves as real estate investment trusts to avoid paying standard corporate income taxes. These facilities are commercial real estate assets, leveraging tax loopholes and government subsidies to function as optimized investment vehicles. Converting a per diem rate into a 40% profit margin requires a ruthless approach to operational expenditures. Private guards are paid roughly 25% less than public sector officers. This lower pay scale contributes to a turnover rate 3 times higher than the public average. Food margins are extracted by providing minimal sustenance. Facilities are expected to provide 3 meals a day for a total daily budget of just $2.50 to $4 per person. Medical costs are managed through artificial liability caps. The operator pays a set amount per inmate, intentionally shifting the cost of catastrophic illness back to the taxpayer. Every dollar saved on human sustenance, safety, and healthcare is converted directly into a shareholder dividend. Dependence on a single government customer creates extreme systemic fragility. The entire revenue stream rests on unpredictable political shifts. The 2021 executive order banning DOJ contracts illustrated this risk, sending prison stocks into a financial tailspin and forcing structural reorganizations of the major firms. A lost contract instantly creates a dead asset. The facility generates zero revenue while the owner continues to pay high carrying costs. Specialized prison infrastructure is notoriously difficult to repurpose. Most closed facilities languish on the market for years before selling for pennies on the dollar. These structures are volatile, illiquid financial traps. They can shed their entire market value as soon as the government exits the contract. The private prison oligopoly is rapidly adapting to these risks by pivoting away from physical concrete structures and into the growing market of incarceration. Heavy investments in ankle monitors and halfway houses provide the same lucrative government contracts with a fraction of the liability and physical overhead. Stakeholders in this market are mathematically optimizing societal failure for profit. This enterprise must constantly expand its reach to survive the very public it harvests.